Hello investors, this is Lukasz Labedzki, Senior Analyst at the Franklin Templeton Institute. Each week, we'll cover the most important developments for investors, we'll look at what happened and how it impacts the markets so you can make smarter, more informed investment decisions. January has concluded, but at the very end of the month, we received a piece of news of high relevance for financial markets: the announcement of the new Fed chair. President Trump nominated Kevin Warsh as the new Fed chair. After being confirmed by the Senate, Warsh would become chair when Jerome Powell's term ends in May. So, there are still a couple of months to go, during which we'll likely receive more guidance. However, it is important to start thinking about what this may mean for investors. In this context, I thought it might be useful to review the latest market expectations and assess how markets are perceiving the situation. The chart shows the market expected Fed funds rate represented by the green line. Markets are currently pricing roughly two rate cuts in 2026, suggesting that aggressive rate cuts are far from being priced in. This may be somewhat surprising, given that the new Fed chair was appointed by an administration that clearly advocates lower interest rates. While Kevin Warsh is viewed as more hawkish than other candidates, it is unlikely that he is entirely misaligned with the administration's broader views. His economic belief is that productivity over the next several years will be relatively high, creating space for lower interest rates. What we do know is that expectations of where the Fed is heading are very important for shorter dated bond yields. Our studies clearly show that the expected Fed trough rate is the main driver of 2-year yields. Given that current expectations for the Fed are fairly conservative, the level of 2-year yields looks quite attractive. This means that short duration bonds remain attractive in our view, as the yield curve is expected to steepen. What does history tell us about the behavior of longer dated yields around new Fed chair inaugurations? Well, 10-year yields have tended to increase in the months leading up to a new Fed chair. They have also continued to rise in the 3 months after the new chair took over. Should we bluntly believe such historical analogies? The short answer is no. Context matters more, and the macro environment during past Fed chair inaugurations was often very different from today's. That said, the current context also provides some arguments suggesting that downward pressure on longer dated yields may be less significant. Warsh is well known as an advocate of a smaller Fed balance sheet, which would imply less scope for the Fed to purchase government debt. When structural buyers such as the Fed, pension funds, and insurance companies retreat, a larger share of issuance is left to more price sensitive buyers, which per se is not positive for longer dated yields, especially at a time when budget deficits and financing needs are elevated. However, Walsh is also in favor of changes in bank regulation that would allow commercial banks to absorb more treasuries. As a result, there are many moving parts that will need to be resolved in the future. Beyond that, we have recently seen nominal growth surprises skewed to the upside, making a clear downward trend in longer dated yields less likely. The last piece of the puzzle is the dollar, and this is more tricky. Warsh is generally perceived as an advocate of a strong dollar. As the chart shows, the USD-EUR exchange rate is in general driven by interest rate differentials between the two currencies. At times, there are deviations from this relationship, and very recently we experienced such a deviation. Interest rate differentials suggested that the dollar should be somewhat stronger, yet the dollar has weakened. After we learned about Warsh's appointment, the dollar recovered somewhat, but not to the extent implied by interest rate differentials. This suggests that the recent dollar weakness has been driven by factors other than rate differentials, including diversification away from US assets by international investors or increased hedging activity. Over the medium term, however, exchange rates typically need to be confirmed by rate differentials, which makes future interest rate decisions crucial for dollar performance. Either expectations of US policy rates decline, justifying a weaker dollar, or, if that is not the case, the dollar may have room to improve. For the time being, we remain in the camp of modest dollar weakness. Thanks very much for listening. Trade well. Cheers.